everyone. Welcome to the Buck Stops here. I am Catherine Murray. Well, we know that the markets really are quite complex and a lot of different moving pieces and parts to the narrative in the marketplace right now. And I really wanted to continue to provide some veteran views of the market and perhaps where we go from here. For perspective on that, Barry Allen is joining us. He's the CEO of DMAT Capital. Barry, great to be with you today, and I should say a real veteran in the fixed income market. So thanks so much for sharing your perspective.
Sure. Good to see you, Catherine.
Thank you. As our viewers know, I pre-taped this, and you and I are speaking on a day where we just had a blowout U.S. jobs number, far surpassing people's expectations. I want to get your perspective on how you're reading that, and it's almost as though, because the market's rallying, good news is treated as good news in the market. In other words, people don't seem to be fearful that the Fed will raise rates. That's my read.
Yeah, I mean, Catherine, at the beginning of this year, my first commentary I wrote is that I've never been as uncertain or seen as much uncertainty going into a year as this year, and that as we go through the year, that's proving to be accurate, even if it's uncomfortable. But even the employment numbers today. The headline non-farm payrolls was way above expectations, but then the household survey was kind of showing the opposite. And we're showing, like, most of the wage data is it is moderating somewhat. So it's very, very difficult to see in the data any definitive trends or indications that they're going to the data trends are going to reverse. So it's difficult. You just got to wait and see how it plays out. But, there's so many data points that have never happened before without a recession that are on now. But definitely employment is the one part of the economy that is dramatically stronger than the rest of the economy. And you would think that shouldn't be, but we're in the aftermath of this pandemic. We've never seen a pandemic before. We don't know what the data is going to expect. We're not expecting small businesses to continue to hire labor as their business deteriorates somewhat, but that's what they're doing.
So a lot to unpack there. I want to first go back, though, Barry, because I've talked about this in the past, but it doesn't get highlighted enough in the media in terms of looking at the non-farm payroll headline number versus what you're talking about and the need to look at the household survey. Why is that more important to you?
Well, I wouldn't say it's necessarily more important, but we do look at it to corroborate the non-farm payroll numbers. And generally over time, they will tell you the same story, but they're not telling you the same story right now. And if there's things that are different this time, it's really in the employment market. But there's a lot of statistical noise in the non-farm payrolls. They have this birth-death model that is predicated on starting and failing businesses. And then there's the seasonal adjustments. And all of those have been materially impacted by COVID and the pandemic. And so they're showing trends that seem to be illogical, but the trends are continuing. So, and until those things start to change, I think that the market, will take stronger payrolls as good news because they think the consensus is that the Fed is about to pause. And I agree with that view.
You agree that the Fed is going to pause. Why?
Yeah. Well, I think as you just look at it logically, and they wanted to get the Fed funds rate to 5%. They raised 500 basis points within 1 year, which has never happened in 50 years. And now they want to give it a two or three meetings to see. That seems logical to me, even if the market
Hmm.
overreacts to every data point.
Right. Okay, we'll take a quick break. We'll be right back. Barry, you mentioned in the previous segment that there are so many data points that counter what the strong US jobs market is telling us. Can we talk a little bit about what you're seeing that leads you to conclude, I think, that the economy is on tepid grounds?
Yeah, well, I think first of all, the most obvious one is the yield curve. I mean, it's been inverted twos tens for over a year now. That's never happened without a recession. The global PMIs are all in contractionary area around the world. And it's not just the US, it's Europe and China, and that's never happened without going into recession. And there's a longer list of things historically that lead us to believe that the economy should be slowing more rapidly than it is. Obviously, the employment part of this is strong, and if people have a job, they're generally spending. But if you look at consumer data, consumer bankruptcies are rising significantly. They're triple what they were a year ago. Credit card
There,
spending is going through the roof because savings aren't there anymore.
but
And
Barry, but the one thing though is I looked at this data the other day as well that the bankruptcies are triple, but they're apparently still at a very low level versus historical norms, correct?
they're not at a very low level, but they're not above average. So they've gone from extraordinarily low back to average.
Okay.
But I think you have to look at those things in the trend because, things generally don't go from really low to average and stop. Usually there's some overshoot there, but
Mm-hmm.
there is a lot of data that suggests that the economy should be much weaker than they are. Um, and, there's biases to the data and there's seasonal adjustments, and pandemic affected all those. So my gut instinct tells me that those trends are intact. It's just the timing is much more uncertainty because of COVID and the pandemic.
Mm-hmm. The negative trends are intact. We just don't know when we'll see more of a downturn because of the
Yeah,
impact of COVID and the amount of spending that's been in place.
yeah. And inflation is coming down, maybe not as quickly as a lot of people think, but you're going to see headline year over year inflation come down a lot in the next couple of months because they're the monthly data a year ago for the next 2 months are 1.2 and 1.0. And the monthly data now is zero point 0.3 or zero point 0.4. So if 1.2 drops off the year over year number and you replace it with zero point 0.3, the year over year number goes down a lot. And so you're going to see, significant drops in the year over year or the annual inflation rates in the next couple of months. It's that what really matters is, are we going to get zero point 0.2 or zero point 0.3 monthly data points, or are we going to get 0.4 or zero point 0.5? And, that's a big difference because if you're getting zero point 0.2 or zero point 0.3 monthly data points, then that leads you to believe the Fed is going to cut by the end of the year. But if you're getting zero point 0.4 or zero point 0.5, not only does it mean that the Fed isn't going to cut by the end of the year, they might even hike further after they pause for two or three meetings and maybe
Hmm.
take the Fed funds rate to 6%. So it's very binary right now, and it's hard to say. My sense is there's about a 70 or 75% chance that the data moderates, but there's 25 or 30% chance that inflation does start to reaccelerate based on demand for labor, particularly.
Hmm.
But you can't look at oil. And I've always looked at inflation as being wages and oil. And oil's
Hmm.
down $20 in the last couple of
Yeah.
months. So if
Yeah.
inflation's going back up, it's going to be on the wage side.
Okay, we'll take a quick break. Barry, we talk a lot about what goes on in the United States because, of course, it has such an impact on Canada and our outlook. But I do want to get your take on the Canadian economy right now and what you're seeing here before we get into some of your ideas and how you position yourself within this uncertain market.
Yeah, well, Canada always has its kind of, you know, things that are unique to Canada. Um, the housing market in Canada was much more extended than in the US. That appears to have corrected. The consumer in Canada appears to be in a little bit better shape than the US. And the savings rates are better, and the consumer debt ex mortgages aren't nearly as bad. Um, so, I think that Canada is whatever's coming is going into it in a little bit better position than the US. Having said all that, Canada is a resource based economy. And in economic downturns, commodities generally get hit pretty much the hardest.
Hmm.
Even though now it's really, they probably react more to economic weakness in China, commodities do, rather than the US, because China uses more commodities, perhaps other than oil. But I would say that while Canada is entering what looks like a period of downturn in a little bit better shape, historically Canada has fared worse in downturns than the U.S.
Hmm. The GDP, interestingly, did come in stronger than expected. What does that lead you to believe as it relates to the BOC and what they may or may not do?
Yeah, it's the Bank of Canada has been a little bit ahead of the Fed. It'll be interesting. I think it's a very close call. As to whether the Fed or whether the Bank of Canada hikes again after having paused.
Mm-hmm.
And my best guess is probably not. But if they do, it might be a one more token 25 basis point hike. I don't think it's a start of a new 100 to 150 basis points rate hike
Mm-hmm.
increase trend.
Right. Fair point. Barry, we talked about at the top of the show, these being uncertain times, or starting the year in such an uncertain way. How do you position yourself in this kind of environment?
Well, I mean, in this environment, you position yourself defensively. That's simple to say and not easy to execute. But defensive in the fixed income world right now, I would say, would be holding an overweight in short duration investment grade bonds, where you can get 6% in 2 to 3 year bonds of companies that have zero chance of default.
Mm-hmm.
That is defensive. And, I think most people would say if you offer them 6% with virtually no risk, people would say that's fine. The problem is if we really do go into recession and the yield curve is accurate, then you're going to get a significant rally in longer duration bonds.
Mm,
And while you're safe in the 6%, you might be foregoing 20 or 25% owning 30-year bonds.
hmm,
So I think you have to have some exposure to longer duration bonds with your core positions in the short end of the yield curve, which is being rewarding you because the yield curve is so inverted and 2-year
right.
yields are much higher than 10 or 30-year yields.
Just curious, in terms of these investment grade bonds, short-term duration, I only have 15 seconds left, but where are they trading versus par?
Well, I think that you can get, most of them would be at discounts because rates have risen
Okay.
so much over there.
Okay,
And so that for tax
we'll take a quick
advantage, that's
break.
good.
Barry, that's interesting. Just to kind of wrap that conversation up in terms of going overweight short-term investment grade bonds. A lot of them you say are trading at a discount to par. So in other words, you get maybe a 6% yield and a little bit of a capital gains.
Yeah. So it's tax efficient because some of your return is taxed as capital gains rather than income.
Yeah, no, that's an interesting call. And then also to be it sounds like being very nimble in terms of, owning those long-term treasuries. Do you buy them now? Do you have some or do you wait?
Yeah, well, I'm trading the long treasuries right now, and like last week they went down quite a bit, and the markets were oversold, so we extended duration. The market generally went up this week, and we'll see how it ends after the employment numbers today.
Mm-hmm.
Um, but broadly speaking, I think the 10-year U.S. Treasuries in a 3.4, 3.8 trading range, and I'm just trading within that yield band and waiting for the period where eventually the 340 will break and we'll head down to 3% or below.
Okay.
And I wish I knew when that was going to be, but
Yeah,
it looks like it's going to take a while.
right. Well, and this is an opportune time to also say, when people hear you trade these, the fact that you do manage an ETF for Horizons.
Right. Yeah, we actively manage it. And um, I think you have to actively manage it these days because the volatility, fixed income volatility is 3 times the long-term average,
Hmm.
which is interesting because equity volatilities at extraordinarily low levels, maybe not of the last decade, where the VIX was 11 or 12, but the VIX is still 15 or 16, and that's well below the long term averages. So fixed
Mm-hmm.
income volatility is much higher than equity volatility.
Hmm.
And we won't get through this whole process until fixed income volatility comes down.
Interesting. Just lastly here, Barry, I'm curious, what's an out of consensus call you have?
Um, I would say one of the out of consensus calls is I wouldn't be surprised if oil actually rose even if the economy was weakening.
Hmm.
I think there's a lot of technical factors, and the OPEC Plus is controlling supply, and China China is storing oil, and the U.S. is about to refill the Strategic Petroleum Reserve. So there's a lot of technicals there that even if a weaker economy should definitely mean weaker oil, but in this case, I'm not sure that's going to happen.
Okay. Any other out of consensus call you want to share?
Huh. Well, you know,
Without,
I think that equity markets are showing signs of being quite stretched. I don't think that's a out of consensus call. I think there's a lot of people think that, but it's not happening, and we'll see whether that plays out. But sooner or later, I don't think earnings can decline and equity indices can go up because seven stocks are ripping, and that's, breadth is extremely poor in the equity market, and that's usually what happens prior to economic downturns.
And it's interesting though, you did mention that we seem to have to be waiting longer and longer. This recession has been
Yeah.
pushed out. What are you specifically going to be waiting for? Got about 10 seconds. What are we going to see?
Well, I think that the markets need to catch up to a lot of the economic data, but really it's the employment market that unemployment rate has to get up to 4.5% to be consistent
Okay.
with everything else.
Okay. Barry, we'll leave it there. Great to see you. Thank you.